Welcome to The Explainer. I am so thrilled to have you with us today as we dissect a topic that has quite literally burned countless new and retail real estate investors. We're talking about the famous, or, maybe infamous is a better word, historical cap rate. It's the go-to metric, the absolute shorthand everyone uses when evaluating a commercial property. But here's the thing, relying solely on historical cap rates creates a dangerously false illusion of security. And today, we're going to break down exactly why historical cap rates fail.
Okay, let's dive into this. Evaluating an asset strictly by looking at its past financial performance? Well, it's effectively like driving a car by looking exclusively in the rearview mirror. You're moving forward, you're putting your capital at risk for the future, but your entire decision is based on what the previous owner achieved under their specific management style, in their specific market environment, with their specific lease terms. Absolutely none of that is guaranteed to continue once you're the one behind the wheel. Now, let's just quickly look at the basic equation. Cap rate is simply net operating income, or NOI, divided by the purchase price. The math is incredibly clean, right? You take what the property makes, divide it by what it costs, and boom, you get a yield. But I really want you to pay close attention to this next point. Its straightforward simplicity is exactly what creates a trap for new and retail investors. It lulls you into this false sense of certainty because it strips away all the nuance and all the forward-looking risks of actual property management.
Section 1. 3 dangerous blind spots. Let's outline exactly why this rearview mirror approach is fundamentally broken.
Our first major blind spot is the stark contrast between in-place NOI and pro forma NOI. You see, historical cap rates rely entirely on in-place NOI, which is just the cash the property generated yesterday. But what about tomorrow? In-place NOI completely ignores upcoming operational changes. It doesn't factor in expiring leases, pending tenant defaults, or imminent tax reassessments that might hit the exact second the property changes hands. You are buying the future, folks, but the metric is only pricing the past. Moving on, here's the second massive blind spot. CapEx is hidden above the line. Because cap rates are calculated using NOI, critical capital expenditures are completely excluded from the equation. We're talking about major structural repairs, like a failing roof or massive tenant improvement allowances required just to keep the building occupied. A property can show a beautifully high, artificial historical cap rate simply because the seller intentionally deferred critical maintenance for years. They kept the cash flow high on paper, and guess what? You inherit all the real world's problems.
And for our third blind spot, the historical cap rate completely ignores debt structure and total return. It is purely an unleveraged metric. It tells you absolutely nothing about the loan terms you'll need to secure, your debt service coverage ratio, or how fluctuating interest rates will actually impact your real cash-on-cash returns. You could have a fantastic cap rate on paper, but if your financing costs are too high, your equity buildup and actual cash flow can just completely evaporate.
Section 2. The high yield illusion. And this brilliantly illustrates why we really need to move past the theory and look at a real-world scenario.
Let's lay out the bait. Imagine our hypothetical investor finds a typical multi-tenant light industrial warehouse. It's 25,000 square feet, listed at a $5 million purchase price. The seller happily hands over the trailing 12-month financials, showing a solid, verified net operating income of $400,000. On the surface, it looks like a pristine, rock-solid industrial property.
8%. That is a phenomenal historical cap rate. To a retail investor, seeing an 8% yield in a market where industrial assets typically trade at around 6% looks like an absolute steal. It's fantastic. They buy the asset, sign the papers, and pop the champagne, fully expecting a steady, easy 8% return on their investment.
Section 3, What the Math Hid. Let's fast forward to year 1 and watch what happens when the trap is finally sprung. Let's methodically walk through the devastating reality of these hidden deductions. First, the anchor tenant, who occupied 60% of the building on an above-market master lease, decides to downsize and leave just 3 months after closing. That is a devastating $270,000 hit in lost income. Next up, remember that deferred maintenance we talked about? Well, the previous owners skipped roof repairs for 7 years. Within 6 months, a structural roof replacement and parking lot repaving are demanded, draining a massive $350,000 in capital expenditures right out of our buyer's liquidity. Finally, upon sale, the county aggressively reassesses the property tax basis from $2.5 million up to the new $5 million purchase price. That adds $45,000 in non-recoverable expenses. None of this, I repeat, zero of this, was in that trailing 12-month snapshot. So, the crucial point is that when we do the actual math for year one, the net operating income plummets from $400,000 to just $130,000. That gives us a shocking actual year one cap rate of 2.6%. And worse, when you factor in that massive $350,000 CapEx check for the roof and the incoming leasing commissions needed to replace that anchor tenant, this property isn't just underperforming, it is heavily cash flow negative. The investor is literally bleeding money.
Section 4, the Pro Investor Toolkit. Let's get out of this trap by opening up the forward-looking metrics that sophisticated institutional pros actually use instead of a static snapshot.
Here is your new arsenal. Instead of relying on a basic cap rate, professional investors evaluate risk, timing, and actual capital costs over the entire holding period using these three primary tools: internal rate of return, stabilized yield on cost, and discounted cash flow. Let's break down exactly how each of these protects your capital.
First up is IRR, or internal rate of return. This metric paints a complete, dynamic picture of your total performance from the exact day you buy the property to the day you finally sell it. Unlike a cap rate, it incorporates the timing of your cash flows, upcoming lease rollovers, your actual debt structure, and the projected sales proceeds at the end of your hold. It answers the ultimate question: what is the actual annualized return on my money over time?
Let's move to and see how this builds true confidence with our next metric, yield on cost, or YOC. This brilliant metric bakes in those hidden capital expenditures we warned you about earlier. Instead of just dividing by the purchase price, you divide your expected stabilized NOI by the sum of your purchase price plus upfront CapEx plus leasing costs. It forces you to acknowledge the money you actually have to spend to get the property performing, giving you the true, stabilized return on your total capital output.
Finally, we have the discounted cash flow, or DCF model. This is the ultimate tool for forcing yourself to look through the windshield instead of the rearview mirror. DCF models your actual expected monthly and annual cash flows over a 5 to 10-year horizon. It meticulously accounts for specific lease expiry schedules, projected vacancy times, and realistic market absorption rates. It brings the messy reality of the future straight into your present-day valuation.
As we wrap up this explainer, I want to leave you with one final thought. The real estate market is constantly shifting, and past performance is never a guarantee of future success. So I have to ask you, are you driving your portfolio by looking in the rearview mirror? It's time to upgrade your toolkit, look through the windshield, and underwrite the future, not the past. Thanks for joining me today, and happy investing.